That's my point. Is if you've been overweight gold for a little while, you're really for 8 years now, you're beating these highly speculative risk assets, and this year alone, you're really crushing it. And I don't see what stops it from going to 4,000 now.
Yeah, no, interestingly enough, I agree. If it can break 3,500, which was that previous pivot high on gold,
Yeah.
it does make sense that it gets another leg up. And I agree with you that, and something that's kind of ironic that I just was thinking about while you were talking about this is, what's the one asset Trump has not pumped? Gold, right?
Gold.
Yeah. Gold. Well, I think he's a golden president, exactly.
Right, but what is he? Him. He like literally has golden toilets. Like
there you go. That's true.
It's like maybe it's the biggest thing in the world. Is like this. Yeah. He's like, I mean, look at what Apple. Tim Cook gave him like a statue or like a placard, like was made out of gold. Like he loves gold, but he's pumping crypto and he's pumping the stock market.
Well, the crypto market helped him get elected. It did. It helped him get elected. It's I call it a Faustian bargain, and that's why I'm sticking with the rock.
Gold has quietly become the most dominant performer in global markets. For years, skeptics dismissed it as a relic, while speculative assets like crypto and high-flying tech captured the spotlight. Yet, the tide is turning. After nearly a decade of underperformance, gold has surged past equities, outperforming crypto on a risk-adjusted basis, and attracted central banks, ETFs, and institutional buyers. The question now is not whether gold can move higher, but how far it can go. In this discussion, analysts highlight that gold's break above the $3,500 level opens the door to a possible run toward $4,000. The backdrop is critical. Volatility gauges like the VIX remain subdued. Crypto is increasingly commoditized, and copper, often seen as the global economic thermometer, is flashing weakness. Against this mixed picture, gold stands out as the risk-off asset of choice, offering stability while other markets wobble. The irony, as noted, is that while Trump has loudly promoted stocks and crypto, he has yet to directly champion gold, the asset most closely aligned with his brand. If gold breaks higher, however, it may prove to be his defining legacy asset, outshining any political cycle. Now, we present the clips from MikeMcGlone and Gareth Soloway's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
To me, what you described is what I fear is happening in cryptos. They are becoming very much commoditized, meaning there's unlimited supply. Prices go down because they went up. Prices go up because they go down. And we're in that stage, right? And they're recycling to all the other ones. Bitcoin went up too far, so we cycled the other ones. Again, we all know there's almost 21 million new ones. And I want to show you the most enduring bull markets that I think is going to go to 4,000 at a clip. As soon as we get a little pickup in stock market volatility, and that's the price of gold. I mean, there's things that are happening in gold right now are substantial. Total central bank holdings of gold now are more, some measures higher than treasuries. Central banks are buying it and more. ETFs are loading up. And I think the difference is gold is a record-setting, risk-off, low volatility asset. See that oxymoron there? Bitcoin is a risk-on asset. So I want to show you a few things that really, to me, is significant in this space. If you look back at, I'll show you this one first. To me, the threshold for gold to take off was the day that Bitcoin first closed above 100 grand. Now we're only 10 to 12% above that level. That was December 6th. Since that day, gold's up 30%. S&P 500 total returns roughly 10%, and the Bloomberg Galaxy Crypto Index is unchanged. To me, that's a key thing to be watching. And also, we're at the point right now, the VIX is at the low for the year. Previously, when the VIX made its high, Bitcoin made its low. This was in April. When the VIX made its previous low, Bitcoin made its high. And now Bitcoin's starting to show divergent weakness. But I want to tilt over a little bit to, I think, what's really happening in that space. The most significant player in that space is MicroStrategy. MicroStrategy's broke below its 200-day moving average from the way up. This is the first time that's happened from the way up since 2021. That's a record. That's a trend line that has to hold. I overlay this with the 10-year note. 10-year note. It's broken down below its 200-day moving average. Right on. That's the one McGlone's been the most wrong on, is thinking that U.S. bonds are eventually going to catch up. 10-year notes at 421. Eventually, maybe. I want to show you the same key chart, and I'm just going to show you two more, and I think that's it. Strategy again, breaking below its 200-day moving average, but on the same scale as I showed the other one is copper, the doctor. Copper is the the metal with the economics, with the PhD in economics. It's breaking down below its 200-day moving average. It's collapsed. This collapse here is earmark of what I remember seeing in 2008 when crude oil collapsed. It's a potential sign that you got to go up, and that's why I point out if you overlay copper with the S&P 500, they're both up 10 to 12% in a year. They're right on that line. They've got to go up, and that's why I'm really worried about this little bear flag here in copper. It's got to go up. But here, and I'll end with this. The key things that are happening in macro is copper is trying to go up with the S&P 500. Again, this is on the same scale, and it's being dragged lower by what's the deflationary forces in China, which I show you, like Chinese 10-year note running about 1.8%.
Interesting. Yeah, super interesting. I would just say, for me, this morning we saw the GDP revisions for second quarter. They came in at 3.3%, better than expected. Jobless claims 229,000. That's nothing to sneeze about or nothing to get worried about. And I guess for me, what I found myself today, we've been told, oh, that last jobs report was so bad. But then you look at jobless claims and they're historically low. And then you look at GDP, it's fine. Does the Fed, Scott, need to really be cutting rates? I know you've been like, they're not going to cut rates, but I mean, the markets are pricing in almost a 90% chance of a September cut. And Jerome Powell kind of opened that door last week.
Here's the way I look at it is I can't trade. I have compliance. It's good. I'm an ex-trader. I'm probably good. I don't anymore. But I look at this as I'd be getting long here, and I'm thinking probably really long, using leverage and using, and I'd probably get stopped out, and then it would go up. And I'm just trying to think, what's going to trip this up? What's going to trip up this trade? Because here's the latest statistics: is gold ETF holdings are just almost at the highest in 2.5 years now. They're up 11% on this year. 4 years of outflows. That's flipped. That's basically never happened with the VIX volatility index 50-day average heading lower. VIX is heading lower. Gold ETF inflows. So markets anticipating something. I think they're piggybacking on what's happening with central banks. And some of it, I think, is just prudent risk asset allocation. You make a killing in any other asset potentially. Why is there so many stable coins now? Because a lot of people made money in cryptos. You got to park it. There's so much people making money in the stock market. You got to park it. And gold's been the place to do it.
Yeah, and I would just say the gold move today in the last few days is coming right up ahead of tomorrow's PCE data, which is that favored inflation gauge by the Federal Reserve. So interesting to see how gold reacts tomorrow. Is gold leading us to know that it's going to be a hotter number tomorrow? In which case, that's probably why gold is pushing up higher inflation. Or does it just end up reversing? And again, that's at 8:30 a.m. tomorrow, folks, the PCE data. And then obviously next week we get the jobs report. But I guess the question is do you think like for me now, or could we go into a recession and just be like, oh, but the number says we've gained 100,000 jobs this month?
The number has been 4.2%. The 12-month volatility of the unemployment rate, which to me is what matters the most, is the lowest in 24 years. I mean, it's just doing nothing. It jumped up to 4.2. It's a bull flag, and it's just waiting to go the next step higher. Our colleagues, Anna Wong, thinks it's going to, by the end of the year, up to 4.8%. Okay, how do you measure it? The key thing is to think about now, since we have this president who's wonderful for gold, is any entity who works at any statistical data collection agency for the U.S. government now knows if the data they're collecting is somewhat counter to the Trump administration, they're more or less likely to be focusing on reporting. That's just human nature. This is where we are. It's going to change at some point in the future, but also the thing is we have significant checks and balances in the country. Why? Because we have people like me who dig into that data. You mentioned unemployment claims. That's from the states. Then we have also data from all the other surveys that's independent. But the point is now we just cannot trust U.S. government data as much anymore. That's where you have to look over at the U.S., look at the market and say, at some point, this is going to trickle down. It's wonderful it hasn't, but the gold market seems to be front running it. That's why I'm quite concerned. That's my point is if you've been overweight gold for a little while, for 8 years now, you're beating these highly speculative risk assets. And this year alone, you're really crushing it. And I don't see what stops it from going to 4,000 now.
Yeah, no, interestingly enough, I agree. If it can break 3,500, which was that previous pivot high on gold, it does make sense that it gets another leg up. And I agree with you that, and something that's kind of ironic that I just was thinking about while you were talking about this is, what's the one asset Trump has not pumped? Gold, right?
Gold.
Yeah. Gold.
Well, I think he's the golden president, exactly. And
right, but what is he? He like literally has golden toilets. Like
there you go. That's true.
It's like maybe it's the biggest thing in the world. Is like this. Yeah. He's like, I mean, look at what Apple. Tim Cook gave him like a statue or like a placard, like was made out of gold. Like he loves gold, but he's pumping crypto and he's pumping the stock market.
Well, the crypto market helped him get elected. It did. It helped him get elected. And I call it a Faustian bargain, and that's why I'm sticking with the rock.
Markets today are sending mixed and often confusing signals. Despite Fed uncertainty, Trump's pressure for rate cuts, and even headline shocks like Nvidia's earnings dip or the firing of a Federal Reserve governor, equities continue to grind higher. Volatility is at rock-bottom levels, with the VIX hovering near yearly lows, and the pattern resembles a tightening spring, what technicians call a wedge. That pressure cooker will eventually release, and the real question is whether it breaks up in a final blow-off rally or down into a deeper correction. The bigger picture is troubling. Record-setting stock indices stand against stubborn inflation, narrow credit spreads, and a Federal Reserve caught between stagflation and political pressure. Against this backdrop, gold remains the clearest signal. Each time policy uncertainty deepens, the metal quietly edges higher, positioning itself as the risk-off asset of choice. Meanwhile, risk-on plays like crypto and high-growth tech face breakdown signals, with names like MicroStrategy and Copper charts rolling over. For investors, the message is straightforward. Markets can stay irrational longer than bears can remain solvent, but gold's leadership suggests a shift is already underway. Let's get back to the interview.
The one thing I've been kind of taking note of recently is that, like, you know, you have Trump firing the Federal Reserve governor, markets were down overnight, and then they ended green. And then you have Nvidia earnings, Nvidia sells off. By today, markets are green again. And here we are just grinding higher. So, Mike, why is this happening? Like, is this like what we call animal spirits?
Oh, yeah, all the above. But remember, it's also a lesson we learned early on in markets is never sell a quiet market. It's August. The VIX right now at 14.2 is on the low for the year. The high close is 52. I remember at 60. Both you guys are big buyers of Bitcoin. But these levels, the key thing is what matters next week and as we get through this. So one more day left in August, one more trading day, and it's a question of how long we can sustain these levels. But it's becoming a little bit, I think, disconcerting. It reminds me a lot of what I remember in 2000 before 9/11. And it's just such a classic malaise before a potential storm. Now, we all know volatility will pick up in the fall, and it's just a question of how much things fall and then how they recover. Now, the key thing is obviously Bitcoin's giving back some. I want to key off a little bit on MicroStrategy, but I'll tilt over to what you want to show there first.
Yeah, I mean, this is just, again, a chart of the S&P. And what's fascinating about this, I'll show you guys just really quick here on the chart, is that you have this trend line going back to October of 2023. It connects through that. Remember that August? I mean, it seems like a millennia ago, but there was this massive sell-off in early August that capitulated with a Monday gap down. I still remember the futures. We were down like 5% on the S&P in the overnight, and that marked that low. And then here's the Liberation Day sell-off. And then look at how every time we get up there, we just tag that line and pull back. And then you have this underbelly. And essentially, this is creating what's called a wedge pattern in technical analysis, which is a tightening spring, right? It's essentially a pressure cooker. And what we know here is that as price gets compacted here, it's going to break one way or the other. And the question is, does it break to the upside or does it break to the downside? And I would dare say that whichever way it breaks, if it breaks to the upside, you probably get some sort of blow off top in the market where we just go up for a week or two just astronomically. Or if it breaks to the downside, you probably see a bigger drop here.
And if we just got a little breakdown in the stock market, it all tilts lower. The key thing about massive cuts, remember what's going to be happening in the Fed. There is a Fed board, Fed chairman, and Trump can push down as hard as he wants, but that's part of the reason I keep pointing over to gold. There's one market that absolutely loves every single word that comes out of his mouth. The gold market smiles. And I think that's going to continue. But the key thing to remember is we'll have very astute economists and market people, economists, not really market people, being appointed to the board, and they will be concerned about their legacy. They don't want to go down as Arthur Burns. So 1 or 2 cuts, but to get them to cut, you basically need risk assets to go down and be cut a lot, because we have the narrowest credit spreads in 25 years. You have record-setting risk assets, and Gareth pointed out we have no problem with unemployment. We have above target inflation. To cut rates in that environment is an oxymoron. It's a third world type country thing to do, and whoever makes those decisions will have to live with them and their children and their legacy the rest of their lives. That's going to happen. Now, he's going to appoint people who are somewhat favorable, but then they're going to get it. So yeah, they cut 25 or 50, but to go to 300, you get catch up what's happening in Japan in an environment that it doesn't call for them, means they were going to go down in history like mud. They will know that once you get that position. So let's be very careful anticipating what's going to be happening from the Fed. Sure, we're going to get towards cuts. The thing is, we might really need them by then, and that's what I'm really worried about. With the key point I make is we have the world's most significant risk-off, negatively volatile, negatively correlated asset to the stock market, typically risk-off. It's setting records, and that's gold. And to me, that's my main warning, that you should be very careful any type of risk assets. As I pointed out, since Bitcoin sit on 1,000, gold's been the best performer. Now you just see gold's ready to make that next leap higher. So, and then you have to think to yourself, why is the Trump administration pushing so hard on the Fed to ease? Like no other administration in history, public. Potentially because they're anticipating things that we've pointed out. The U.S. stock market and U.S. risk assets are the highest ever. Now, I'll end with this. To get through this very mercurial, discombobulating president, which all his policies might turn out to be right, but he's shifting the world order without at least or more than a 20% correction in the stock market that stays down, will be very rare. Now we have 3.5 more years, and so far we've had just one little, shot across the bow. That's why I like to point out, stick with the gold and risk-off assets, and that's why I'm looking for indicators like MicroStrategy breaking down.
I would say so. So my interpretation of what Trump is now doing is he's now getting to the point where he realizes he needs cuts for 2 reasons. One is the U.S. is something like $7 trillion needs to be refinanced this year, and they can do that by short-term rates, right? So we know he doesn't control, or the Fed doesn't control the long end yield curve. But if he can get those rates down to 2% on the Fed funds, then they can at least do the short term until those longer term yields come down. And then the other thing too is I think initially when he got in with Liberation Day, I think he was trying to tank the markets. I think he said, hey, listen, I got to drop the markets so that I can have them rally back to all-time highs by the midterms. But now he kind of got scared by that, right? It was such a dramatic drop that now he's pushed it back up, and he's just like, hey, I got to keep the pedal to the metal and keep these going higher until the midterms.
He's already thrown, I guess he's already tilted that way. The things that he says are just, every time he speaks, I think gold says, thank you very much. But the key thing there also, what's happening, what markets are telling us in this environment. Yeah, record-setting stock market, but that's the problem. Is it going to stay in this trajectory for the next year? This is about the time of year people are going to start thinking about the polls. And like I said, that's why I'm so concerned. I'm as concerned as I was in 1999 and in 2007, and I didn't have these kind of rallies in gold and plunging crude oil and things like that. That's just why I'm wish him good luck.
Yeah, no, I happen to agree. Looking at the markets, needless to say, I've looked at the markets. The charts are telling us we're overbought. Yet every time we open lower, we grind higher. And it's if you're a bear right now, you are just like helpless. It's the same feeling. You're right. I had it in 99, 2000. It was just like, what the heck is this? And then even to some extent in 2007 going into 08, it was very similar with just the consistent grind. Nothing could take the market down. And the biggest thing we all know, and we've learned this often the hard way, I know I have, is that the market can essentially stay grinding higher longer than any of us can stay solvent or driven on that position. So it's interesting to see here, but it's certainly that same feeling that you're mentioning, Mike, is that feeling that's not healthy, but at the same time, it's hot potato. Like, how long can it last before the music stops?
Well, that's what's different too, is any entity and people, I hear hedge funds are really starting to get involved too. At the beginning of the year, said, yeah, things like I said, I still think this is going to be a potential down year for the stock market, maybe the start of the third 50% drawdown in the stock market since 2000, who came in the year overweight gold and treasuries, is keeping up and actually beating the stock market. Okay, obviously not beating, and even beating the broad crypto market. Now, If they're knocking around and trading, sure. But that's what's different is, yeah, it's one where it's in the pile on trade. You got to be in it because your neighbor's getting rich and you feel horrible when you're not. But just holding on gold is doing just actually outperforming. That's the scary thing I find so far this year, which means that might be a pile on trade.
So last week we heard from Powell at Jackson Hole. He opened the door to saying maybe rate cuts. What was so shocking, like initially we saw the market just rip higher and really it's kind of chopped sideways to up since then. But he was like, okay, so inflation's going up and the labor market is getting weaker. Wow, he just literally said stagflation. We are in a stagflation environment. And then he added, we're going to start cutting rates in an stagflation market or environment. And to me, that's just like, really? Like, is that where we are at this point? Are things that bad where, you have stagflation and you got to start cutting rates?
There's things like, yeah, he's already set up his fall guy for covering, I should say but it's going to be when we do have some normalization of risk assets, which means the stock market goes down. And yeah, I've been wrong for a while, but gold keeps beating everything. And that's one thing I want to show you in the chart. So you don't see these on all the screens I watch right now, CNBC and all that. You don't see the fact that it's been almost 8 years now that the stock market, the S&P 500 total return is flatlined versus gold, and the Bloomberg Galaxy Crypto Index is flatlined versus gold. That's not a good sign, but because historically, almost always over time, that S&P 500 total return divided by gold goes up. You go back 100 years, it just goes up, and when it starts rolling over like this, beware. And it just got a lot of reasons. I just look for the VIX is at the low for the year about right now. We talked about this earlier. We're getting that zone, and there's gold is itching up to a new high for the year. Which one's going to win by the end of the year? This is going to be an exciting trading environment. The way I look at it, though, is if we end up down or so on the year and gold continues higher and stock market continues lower, that's a setup for a really pretty big significant correction like we've only had two of since the beginning of the century. And we've only had two down years in S&P 500 since 2008. And that's when people get emboldened, and that's when bad stuff happens.
So one question I have for you guys is that, someone said this to me in one of my rooms, my trading rooms. They said, with all the money that's in the system and how the government is just continuing to spend, even though supposedly Doge was going to cut all this spending, but it didn't really happen. And then you have all the Fed starting to loosen monetary policy. Like, will the markets ever go down? And my response, obviously, and I think it'd be the same as you guys, is eventually yes. But if they just keep doing this, does this enable the buy the dippers to eventually win out again and it just goes right back up?
Gold continues to stand out as the asset that quietly absorbs uncertainty, while broader markets flirt with danger. Equities continue to grind higher on a fragile footing, propped up by speculation and political pressure, while underlying risks remain unresolved, namely stagflation, debt loads, and narrow credit spreads. Each major shock, from Fed policy shifts to Trump's push for rate cuts, reinforces gold's role as the one asset that thrives when confidence falters. When risk markets look unstoppable, yet the real signal is flashing in the metals. The leadership of gold, the divergence with crypto and copper, and the record inflows into ETFs all suggest that the next decisive move could favor those positioned defensively. Share your thoughts on the experts' analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.